So for basics, what you have is a breakup structure. Once price breaks that structure and comes back inside of that structure that was broken, you have your dealing range. Same thing inverted. You have your breakup structure. Price comes back inside of that structure that was broken, and you have your dealing range. So to keep it simple for now, we're splitting the range into 3 parts, into discount, fair price, and premium. So here you had your breakup structure, and now this is your range. This is your discount, and this is your premium. Price tried to react from that premium, failed, and broke structure. So now this is your range. And we're going to talk about why we didn't use this middle swing in the further chapters. So basic repricing is when price moves from internal liquidity to external liquidity. Basically a basic breakup structure and a retracement back inside of the range for a supply or demand zone. Compressive repricing is when price moves from one internal liquidity to the opposite internal liquidity. Price moves from one extreme to the other. Easiest way to spot this is to look at where price rejected internally at a scenario where you expected price to break structure. So for context, this was our 2 previous ranges. And now we have a break of structure, and now this is our new range. Price reacts from premium, break of structure, new range. Price fails to make contact with our premium, but here we have a break of structure, so now this is our new range. Price reacts from the premium, break of structure. This is our new range. Break out of our range, break of structure, and here is the new range. So now that you have this break of structure, where would be our new range? This would be our new range. So on a daily time frame, what you have is a reaction from a macro supply zone. And let's look at what happened between your supply being formed and the reaction. What you have is price moving in a channel. And inside of that channel, price is taking out lows and taking out highs, taking out lows and taking out highs, and so on. So now let's zoom in on a lower time frame and see what really happened. So what we have on the lower time frames is we have a break of structure, a range is formed, and now price is stuck inside of that range in between internal levels. So this is an internal to an internal trap. Now price breaks structure, forms inducement swing, price absorbs that inducement swing and continues interacting with our macro supply. So the master range is the macro that's dictating the order flow. The best way to describe master range is that higher time frame is king and will override lower time frame direction wise. So regardless what occurs on the lower time frame, the master range will typically hold priority. So in the macro structure, we have a liquidity sweep, but now in the lower time frames, we have a breakup structure to the upside. So what a lot of traders would do is they would mark up the range and they would anticipate price to drop down to discount so they can take price higher since the breakup structure was to the upside. But don't forget what happened previously. You had a macro sweep. And since you had this macro sweep, you need to understand that the master range will always dominate, typically. And you would still be operating within this range. So since you are still in premium and you just came back inside the range, you're anticipating price to get back down to discount. Here we have a macro breakup structure, and here is our master range. And inside of our master range, we have our micro range. So previously we had a breakup structure, and this was our micro range. And now we have a new micro range. Again, micro range moves inside of our master range. So lower time frames moving inside of our higher time frames. Price reacts from our premium, breaks structure, and forms a new range. So now what did price react off? Price reacted off our master range, an extreme discount. And we're going to cover this in the further chapters. So now inside of our master range, we have another micro break of structure. And now this is our micro range. So let's talk about extreme zones. And the best way I explained this previously was using our shirt example. So let's say there is a shirt that you're looking to purchase for an investment. A shirt that you can purchase at a specific price and sell at a higher price. Now, if you go to any retail store, this shirt is currently worth $5. But if you can find a way to purchase the shirt for a lower price, let's say $2.50, you would purchase it at $2.50. And then as the shirt's value rises, you would try and sell that shirt at its highest potential. So anywhere from $7.50 or all the way at $10. And this would be your extreme zones. purchasing price at the lowest point of the range and selling price at the highest point of the range. So here's the master range. And now you have a breakup structure on the micro time frame. You have a bullish breakup structure. So now this is your micro range. Price fails that range, break structure to the downside, and now you have a new micro range. And now price fails that structure as well. So what you do is look to the left and see that price is taking out your master range's high. So if that's the case and price breaks structure on the micro, then you could anticipate price to head to an extreme zone or at least to discount. So now you have another micro breakup structure. And now this is your range. And price dropped down. What did price react of to go bullish? Your master range. Now let's talk about what happens inside of the master range. What's in red will be your higher time frame, which will be your master range, and what's in black will be your lower time frame. Price is currently coming back from a higher time frame sweep, so technically you're in premium. Price consolidates, and that usually happens at zones where decisions must be made and price is indecisive. Price comes out of the consolidation, and the next point of contention is fair price, where you could anticipate typically a minor reaction. Breaking through fair price, price is heading towards demand. Now you will get another consolidation. Why? Because this is a decision point. Your extremes are your decision points. Now price reverses from your demand and heads back to your fair price. Another contention at fair price. Price breaks out of that level and heads where? To your premium. And that's where you get another consolidation, either a rejection or a breakout. Here we have a breakup structure, and now this is our dealing range. And on the higher time frames, it would appear more clear because you would eliminate all these micro swings, but we're staying on the 1 hour for micro purposes. So now price heads to our fair price. And here is where you got a little bit of turbulence. And now price forms a micro range. Price reacts from that micro range and breaks, so now a new range is formed. Price reacts and then fails again and heads to discount. So now you have an inducement swing. Price gets below the inducement swing, and now your new range is formed. Price heads to fair price, point of contention. Now you have a new range. Price breaks out of the master range. And now this is your new master range. Price fails to retrace deep inside of that range, so it abandons that range. So this could be a change of profile. And now this is your new range. A supply and demand structure is when price retraces deep inside of the range. In a bullish market, price will pull back into discount. And in a bearish market, price will pull back into premium. Support and resistance structure is when price does not retrace deep inside of the range. Instead of going for a deep retracement, price reacts from the last flip zone. An inducement swing will tempt you into misidentifying a range. Misidentifying a range will induce you into taking a bad trade, aka fake supply or demand. So here we have our dealing range. Price reacts from that dealing range and breaks structure. But if you take a look, you'll see that this retracement was not a deep retracement. The pullback inside of this range did not react from an extreme zone or, in this case, even our discount. So a lot of traders would think this is our dealing range. But in reality, we know this is an inducement swing to induce traders into taking an early position. And this is simply liquidity. And the entire dealing range is this. So now price will take out that liquidity, interact with the extreme zone, and react. So a lot of traders would identify this as our dealing range. But as you know now, this is simply an inducement swing where liquidity is resting underneath, and you would anticipate price to absorb that liquidity and target a potential point of interest or our extreme demand zone. So now, what are the clues that you could pick up that this is a potential inducement swing? For one, you're looking at the breakup structure. You're looking for that swing to be formed at a breakup structure, forcing a breakup structure, or prior to a breakup structure. Another clue is price is coming from a change of character, where the direction changed from bearish to bullish or bullish to bearish, obviously macro speaking. And our last clue is that pullback did not reach a discount zone. So it was not a deep pullback. And finally, the inducement swing typically is not a deep retracement, where price does not go beyond fair price. So here's another example. This would be our fake range. Why would this be our fake range? Because this is an inducement swing. You take a look to the left, you had a break of structure, and that swing was responsible for that break of structure. And before that, you had a master range sweep. A lot of times when your master range is swept, this is a change of character on the lower time frames. So now this is your range. So here you have your inducement swing. And price reacts from an internal liquidity level instead of absorbing the external liquidity, which is your inducement swing. So if you do form your range right here, you wouldn't be completely wrong because price did abandon the range. But then again, you're always running the risk of price coming back and absorbing that inducement swing. So the conclusion is price could always come back after multiple cycles to absorb that liquidity. So here's your fake range, and prior to that, you had a break of structure, and this is your inducement swing. So underneath that inducement swing, what you're looking for is point of interest. In this case, you have an order block right here, and you have an order block right here. So what you're waiting for is for that liquidity to be absorbed, and once price runs that liquidity, it will more than likely head towards one of these point of interest. So a common mistake traders commit is they mark up the range prior to any confirmation. So they would mark up the range something like this before any confirmations. And the problem is there's multiple points of rejection. So one rejection could be the bottom of the shelf. This could be your basic support and resistance. The other rejection would be your flip zone, which would be your demand turn supply, since this is a bearish example. And the easiest way to remember this is grab the swing prior to the break and the high of that swing and mark up your extreme zones. And as long as price did not get out of, in this case, our demand zone, this would still be invalid. So the easiest way to remember this is to grab the swing low prior to the break of structure and grab that swing high and mark up your extreme zones. And once you mark up your extreme zones, if price breaks out of the first extreme zone, then your range is confirmed. And here are some other reasons why you should wait for a confirmation. So let's talk about profile change. Structure changes profile usually post break of structure. Profile changes from one structure to the other. If price is delivering in supply and demand, it will change to support and resistance. And if price is delivering in support and resistance, it will change to supply and demand. Here's an example. Price is moving in a supply and demand structure. And once you had that break of structure, now price is moving in a support and resistance structure. So now let's talk about the operating time change. This is when price changes the time frame it's delivering structure in. Typically occurs post break of structure as a sign of abandoning the range. When the operating time frame changes, the profile doesn't necessarily need to change. It can remain the same, but the points covered changes. And by points, I mean pips. Either your swings shrink or expand. So either your swings get bigger or your swings get smaller. So here's another example. As you can see, price was moving in a supply and demand structure and price reacted from an extreme supply zone. But once structure broke, the operating time frame changed. Even though the structure remained the same, price is still moving in a supply and demand structure, but the swings got a lot smaller. And what really happened is previously price was operating at a higher time frame, and once price broke structure, price started compressing. So now price is moving in a lower time frame. So as far as entries, for the most basic entry model, what you want to do is you want to buy low and sell high. So what that means is you buy at extreme discount and sell at extreme premium. So another simple entry would be trading the break and retest when the market is in a support and resistance profile. And we explain this deeply on our website. The way you anticipate whether price is in a support and resistance structure or a supply and demand structure is you wait for a profile change and count your phases and look at the size of the breakout, as supply and demand breakouts are pretty small and support and resistance breakouts are more aggressive. Other variations would include the inducement swing. You can wait for that inducement swing to be taken out and wait for a new range to be flipped and take the trade in the opposite direction. Another entry model is waiting for that inducement swing to be taken out and wait for price to interact with a point of interest, whether it's an order block or a fair value gap. And you could also wait for price to get down to an extreme. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and let us know what lesson you guys want next. Till next time.